I'm delighted, given the theme of the conference is beauty before age, I've been chosen to go first here. Although I have been referred to a granddaddy, I noticed a little earlier. I have not prepared any slides. I'm not going to stumble over my slides. I haven't prepared any. I thought perhaps, well, I didn't get Jeff's slides in time. He was still shampooing them last night. And I thought perhaps just 10 minutes I could talk without slides. But realised coming in here how slides I always thought were to help the audience, but they really are a prop, you know, for the speaker. I don't have any slides, so I'm going to, as an old guy, I'm going to talk like we used to talk in the old age and just talk. I come at this, when I started thinking about this topic, I came from a historical perspective, much like Jeff did when he started. I can remember the first, when I did financial statement analysis, which, yes, it is a long time ago, we had one of those blue and black Irwin books by Bernstein, okay? Financial statement analysis. It was a stock book in those days. I like this book from the point of view it's a very grey book. Those blue and black Irwin books were very grey. You had to read them as a student and understand them. Quite different from the modern books, which with the multi-technicolour chocolate blocks look, which you have to put sunglasses on to read them. But it turns out, we're going through my first financial statement analysis class. You go through Bernstein, which I should say has been admirably redeemed by John Wilde and KR. We got to the end of the course and I realised it was all about calculating ratios. This is how you calculate. It was called ratio analysis in those days. Here, how you calculate return on assets, solvency ratios. And in the course, you turn to the professor and say, well, okay, what am I supposed to do with this? Where's all this ending up? And the light really went on, I think, when I first read, I guess after I got to Chicago as a PhD student. That gave me a little bit of a mental confusion also because those days, of course, market efficiency was very strong. And so the notion was that sort of this financial statement analysis doesn't get you anywhere anyway, okay? Which pulls you up a bit straight. But then I read this paper by Bill Beaver. Remember that 1966 paper on counting ratios and outcomes, bankrupt, non-bankrupt firms. And the light really went on. Here you actually saw a number of accounting ratios discriminating on outcomes. And of course, what I'm getting to here is the financial statement analysis only comes to light, and I really do believe the only way to teach it is when you really have a product focus in mind. It's got to be used for something. And so you saw financial ratios actually discriminating in advance against ex post outcomes, in this case default and non-default. And of course, I think it was Altman who went on and sort of built a product around that. Now, you look back on it, it's sort of little playing with mirrors, I think. But, you know, it pointed out to me that if I'm going to teach financial statement analysis, it really has to have a product focus. And I'm very delighted that Peter's chosen at the end this conference session with a panel on, hey, products. It's gratifying we're having this conference. For many years we laboured in accounting research, doing, well, some of us doing analytical work, but many of us here doing capital markets research. And we steadfastly held to the notion that we're doing capital markets research, but we can't say anything to the standard setters. We really can't say about anything how you should do your accounting. And we didn't really have much product impact. Meanwhile, our colleagues in finance were developing products which sold, some successful, some not successful, and got the attention of Wall Street. I think the good news is that in the last several years, the last 10 years or so, with the development theory of valuation, Olson, Feltham work, and the empirical work, we've actually got to a point of actually bringing more products, product focus into our class. And I think that's the big innovation. And that, in my mind, we should insist as being the driver of what we're doing. And that's what we should be doing and delivering to class and, of course, delivering to practice. Now, saying that, when you come to teach financial statement analysis, I think it's very important to recognise what are what are product features of the accounting and what are sort of immutable features of the accounting we're always going to hold. I get irritated by students that they don't sort of understand the basic structure of accounting when they come to, say, a valuation course with financial statement analysis. They don't really understand the structure of accounting, certain things that have to hold. So, for example, there's certain fixed accounting relations. And for any product that's going to employ a spreadsheet with to do some analysis, whether it's equity analysis, whether it's credit analysis, those accounting relations have to be honoured, and you've got to understand how the cash flow statement reconciles to the balance sheet through the income statement if, in fact, you're going to do credit analysis and you want to have some forecasting of cash flows. You've got to under that structure if you want to do earnings forecasting. And I think that's very important. And that can be taught quite independently of the product focus because that's always going to be there. Other features are always going to be there. If, in fact, you borrow, you're going to, under typical conditions, and I know there are exceptions, you're going to increase profitability. If you're going to repurchase a stock, repurchase shares, under most typical conditions, you're going to increase earnings per share, and you expect to have higher earnings per share growth. This is just the features of the accounting, and this should be understood. However, the product focus has got to come in. So if you think about equity valuation and you think about stock repurchases, for example, then you've got to bring the accounting along with the features of the accounting and how it has to work along with the valuation. So you come to stock purchases, and contrary to most things you read in the press and The Economist and Wall Street Journal, they're doing stock repurchases to increase earnings per share. This is supposed to be good. Well, you come to valuation, you're starting to say, well, if you actually buy back stock at fair market value, hey, yes, it increases earnings per share and earnings per share growth in expectation under most conditions, but it doesn't change the value. You've got to think about it very differently and how to handle the accounting. And that, of course, is the product focus coming back to the accounting. Other immutable things that students, I think, need to understand is income shifting. If you write down book values, this has certain consequences. All else equal, you're going to have higher earnings, and you've got to have to increase your earnings, your forward earnings forecast or your future earnings forecast. But those immutable things aside, it's very necessary that we have a product focus. Having said that, then, a product focus, then we've got to turn it around. If we adopt an equity valuation perspective, then we've got to ask ourselves, well, if that's perspective, it's got to come back to address the question, how should you do your accounting? How should you do your accounting for equity valuation? One thing I disagree with Jeff, your name is, yeah. Jeff's comment was the accounting does not matter, okay? Not sure it's his statement, but it's a common statement. Well, of course, if you have an infinite horizon forecast and a known long-term growth rate, accounting doesn't matter. But as the old fundamentals will tell you, this long-term growth rate is pure speculation, okay? It's not much to do with the accounting in a sense. The accounting does matter. What would I prefer? Would I prefer forward earnings? Would I prefer book value? Or would I prefer cash flows for equity valuation? The accounting does matter. And then that question is, how does the accounting matter? It's like if you want accounting for performance evaluation, EVA-type metrics. Well, you're told, hey, you can't use GAAP accounting, you've got to come back to accounting re-audit and have all these adjustments, capitalise R&D and amortise it. Well, best of luck with the amortisation rates. But how do we account for value? And that ultimately turns the product focus back to our research and how we think about the accounting and gets back to the account. Well, what is good accounting for equity valuation? And I think that is very much our research agenda in the future. An example being, of course, is stock option accounting. From an equity valuation point of view, the FASB doesn't have it right. Because if you issue a stock option and it's never exercised, there's no cost to shareholders. It's only a cost if it's exercised. These are sort of the issues that we have to come back to. Product focus, turning it back on ourselves, says, well, what is the good accounting for equity analysis? What's good accounting for credit analysis? What should be those ratios in the Beaver model, and how should you account for them? My time's over.